My fellow Americans, this is Liberation Day.
Hello and welcome to the week ahead on Nomura Podcasts. Today is Friday the 4th of April and I'm Dominic Bunning, Head of G10 FX Strategy here in Nomura's Global Markets Research Department. You join us after another tumultuous week in financial markets following President Trump's tariff announcements on the 2nd of April. Tariffs were broad and generally larger than expected, and financial markets did not digest them very well at all. Although there is now some resilience coming through in US labour market data, which proved a little bit better than expected. As we record this, however, the S&P 500 is down around 12% from its February peak. The Nasdaq has fallen even more. US 10-year yields are below 4% for the first time since October last year, and the dollar has fallen to its lowest level on a broad basis since the same period of time. We'll go into detail of what trade policy is actually being implemented and what it means for various economies with David Seif in the US, George Buckley here in London, and Sonal Varma from Asia. We'll also, as always, preview the other key events coming up. So without further ado, let's get stuck in to the week ahead.
April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed, and the day that we began to make America wealthy again. Going to make it wealthy, good and wealthy.
Well, the only place to start this week is in the US, and as we just heard on the clip there, President Trump's promise is to make America wealthy again with his tariff announcements that came on the 2nd of April. David Seif, our Chief Economist for Developed Markets, is with us. So, David, in broad terms, what's been announced and what do you think the impact is going to be on the US economy?
Well, as expected, Trump announced a new set of tariffs on April 2nd, but the magnitude of them was certainly bigger than expected. So tariffs, which we were expecting to be in the 10 to 15% range across the board, rose much higher than that in the case of a number of countries, 20% in the case of the EU, 34% in the case of China, and then much higher as well on major trading partners like Japan, Korea, and Vietnam. So ultimately, this is both a hit to growth, we think, and a boost to inflation. And that does put the Fed in a bit of a difficult spot, right? So when you think about the negative impact to growth, that pushes the Fed to be more dovish. But when you think of the positive hit to inflation, that makes the Fed want to be more hawkish in order to control things and keep tariff-induced inflation from really spreading around the economy. Ultimately, we think that the Fed is going to have to prioritize inflation first. And we think that for a couple of reasons. First of all, it just had a pretty bad experience a couple of years ago, of course, with the post-COVID inflation, and it doesn't want the same thing to happen with this tariff inflation. Second of all, although we do see a non-trivial hit to growth, we do think the U.S. is more likely than not to avoid a recession. And that's going to be our view unless we see the hard data really break down more than we have seen it break down and more than we expect it to break down. So we start with a place of pretty close to full employment. After today's employment print, we have 4.2% unemployment. That is still pretty low historically. And we don't think that that's going to climb all that much over the course of 2025, simply with below trend growth, but not a recession. And so we think that the Fed for most of the rest of this year is going to prioritize keeping rates restrictive to let the tariff-induced inflation impulse pass, and then only resume cutting in December 2025.
Okay, great, David. I think based on what you've said, I've got a pretty good idea of what the answer to this next question is going to be. But we've obviously had a pretty turbulent week in markets, especially in terms of the decline in equity prices. Rate markets pricing in quite a big degree of rate cuts now. How much tolerance do you think both the Fed and the Trump administration as well have to further equity market downside if it were to materialize?
Well, we should talk about them each separately. The more important one here is Trump, because only Trump can reverse the tariffs. All the Fed can do is, of course, accommodate monetarily, which has a much smaller effect, we think. And in the case of Trump, we do not see a quote unquote Trump put as being anywhere close to the money. So what do I mean by that? I mean, it would take a lot more pain than people seem to think for Trump to reverse course. We've published on that, led by senior U.S. economist Jeremy Schwartz, on how far out of the money we think a Trump put may be. And the key insight behind that is that although, like many presidents, Trump has, during the course of his presidencies, liked to tout the stock market when it has been high. And again, I mean, all presidents pretty much would do that. Trump has not really reversed course when things have gone south with the market. And we can look back to his first term, late 2018, the market was selling off pretty aggressively. And Trump did not backtrack on China tariffs and other policies then. He's been pretty resolute in this. Now, that isn't to say there aren't opportunities for specific deals to be made on some of these especially high tariff rates. But the bottom line is we expect that the bulk of these tariffs are going to remain in place, and that any sort of backtracking or deals that are being cut will be quite small compared to the overall size of the tariffs. When it comes to the Fed, we continue to feel, as I said, that the Fed is going to need to prioritize inflation. Obviously, there is a real chance that there will be a bigger hit to growth than we expect, or a smaller boost to inflation than we expect. And in that case, I think then, of course, we would have to re-examine what the Fed will do if the economic data are coming out differently than we expect. But, I would say that even if the Fed were to cut several times from here, that is not going to solve the situation in anywhere near the same way that actually pulling back the tariffs would.
Yeah, I think that makes a lot of sense, David. Now, you mentioned inflation, obviously, a couple of times. Next week, we do get the next round of US inflation data. What are we expecting? Things going to stay pretty sticky, I guess?
We're expecting core CPI to rebound to 0.3% on an unrounded basis. It should round up to that, so it'd be a high 0.2. And that's largely due to front loading of purchases, preemptive price increases in anticipation of higher tariffs, pushing up core goods prices. But the key thing here is that we don't think that most of the tariff effect will have shown itself in March CPI. We think that's still a little bit early. I mean, the tariffs aren't even going into effect in most cases until April. They weren't even announced until April. One interesting thing, and of course we won't find this out this week. It won't be until later in the month. But we actually think that core PCE, which was particularly hot last month, could actually come back a bit this month. So it rounded up to 0.4 in February, and we think that it could actually round down even as low as 0.1. And that's really due to some of the PPI data that are relevant for core PCE that we think likely softened in March. But overall, we think that a little bit of an increase in March CPI, but still too early to really see the inflationary impact of most of the tariffs here.
Great. That's great, David. Thank you very much, and we'll speak to you soon.
My pleasure.
European Union, they're very tough, very, very tough traders. You think of European Union, very friendly. They rip us off. It's so sad to see. It's so pathetic.
Now, moving over to Europe, we've just heard from President Trump there claiming the EU are very tough traders, leading him to impose a 20% tariff on the European Union. got George Buckley here, our chief European economist. George, it's obviously at the top end really of expectations in terms of the tariff rate. What impact is this going to have on the euro area in your view in terms of growth and inflation?
Yeah, it is on the top end. We had been expecting, I would say forecasting, but it's more of an assumption we'd based all our forecasts on was that they would do 10% across the board, whether that be for Europe, for the UK. Now, of course, for the UK, we did get 10%, but for Europe, it was twice that at 20%. We are not convinced that we will see any negotiation, not for want of trying, but I don't think it's going to be possible. So I think we're going to end up with 20%. I suspect that Europe will not go the whole way in terms of retaliating, but still, we think it's going to have an impact, quite a notable impact on our forecast. We'd already revised down our forecasts for growth on the assumption of 10%. We've taken another 0.2 percentage points off our growth view. We've added 10 basis points to our inflation forecast. So, yeah, it's not a great combination, and that might not sound very large, but I think it's worth bearing in mind, of course, that the US is just one, albeit a very important one, trading partner of Europe, whereas the impact on the US is a lot larger because, of course, they are doing these bigger tariffs to every single country they trade with. So it's obviously a bit different when you look at it from a single trading partner versus the US, where they're obviously adding tariffs and large tariffs to everybody.
And in terms of the policy response, I mean, you kind of mentioned you didn't think it'd be much retaliation. Is there anything else the European Union can do in response? And also in terms of policy, what about the ECB? What are they going to do next?
So on the ECB, we have taken we've taken another cut into consideration. We were thinking June. It was very debatable. Lots of noise about whether they might skip April. I think that seems a lot less likely now. We've not got much data to come over the course of the next couple of weeks before that meeting. So that's probably not going to shift the dial, but I think the tariff view or the tariff announcement will. And that's why we've now got two more cuts. We did have just June. We've now added April to the mix. So we're down at 2% for the end of or the terminal rate. In terms of what they could do from a fiscal perspective, of course, we've had a lot of fiscal announcements in Europe. They could reinstate the Shore program. That was the program that tried to support employment across the EU back in the pandemic times. They spent about 100 billion on that. And I think that could be beneficial for a number of reasons, not just for supporting growth. It's probably worth, if they did another 100 billion, maybe 0.5% of European Union GDP, but also it might prove an extra kickstart to this idea of joint financing, a more sort of common issuance theme to Europe. So I think it could be positive in terms of expectations and more joined up thinking from a European level. So lots of things they could do from both a monetary and fiscal standpoint.
Yeah, and I think from an asset perspective, that's certainly something from the euro currency side that we think is important. The signs that Europe is kind of, I guess, getting its act together a little bit at a time when the US growth inflation mix looks worse, is potentially seeing quite a big shift in portfolio flows back towards Europe out of the US and seems to be a big driver of why the euro has been performing very well recently. Just while we've got you, George, anything else that you want to flag in terms of the weekend? Any major data points?
I mean, all the data points seem relatively minor relative to what we've seen, of course, over the past few days or yesterday with the Trump tariff announcement. But one thing I would say is that we do have the Centix survey. It might not be the thing which moves the market that much, but I would say it's actually a survey which will be based on responses which they'll have received over the course of this weekend. The survey opens this evening, Thursday evening. It goes all the way till Saturday. So it will be reflective of this. Now, a month ago, of course, you had a reflection of the fiscal announcements, which are very positive. Now you've got a reflection of the Trump tariff announcements, which is going to be negative. So I wouldn't be surprised to see all of that positivity unwound in this survey.
Great. Thanks very much, George. Have a good week.
Thank you, Dom. You too.
Well, we're going to head over to Asia now, where we've seen some of the biggest tariff increases from the US and where we're joined by Sonal Varma, our chief economist for Asia, ex-Japan. Sonal, thanks for joining. The impacts of these tariffs seems pretty big for Asia. How have the developments affected your thinking and your forecasts?
Yeah, Dom, it's much worse than expected. And we think Asia is going to be hit the hardest because it is essentially home to the export-oriented economies. What's interesting is that the highest tariff rates have been imposed for Southeast Asian countries. So they are anywhere between 32 to as high as 49% in terms of the reciprocal tariff. And particularly for countries like Vietnam, Cambodia, Thailand, which actually in our analysis stood out as countries that were being used to circumvent higher China tariffs in the last 8 years. So it's not entirely surprising. Now, the question is, how do Asian policymakers react? Our view on this is that Asia is likely to negotiate with the US rather than retaliate, mainly because the leverage that policymakers have here is less, and they do want to access the US market. So the plan going forward would be to try and see if there could be a bilateral trade deal, and of course, buying more of U.S. Products, whether it's energy, agriculture, and investing in some strategic industries in the U.S. The other question is with respect to what this means on the economic outlook, and we think this means sharper than expected growth slowdown and more disinflation. The growth slowdown will hit the region mainly through the export channel, but we also expect the uncertainty to hit investments. So we have made some big growth downgrades in the region, with the biggest cuts in Thailand, where we've cut our growth numbers by zero point 0.6 percentage points for this year, Singapore by 0.5 percentage points, and some of the other open economies like Taiwan and Korea, where we've cut our numbers by 0.3 to 0.4 percentage points. And as I said, I think disinflation is going to get reinforced, and this is a big difference to the US, where we are expecting higher inflation. So we do think there's going to be a divergence in monetary policy. So the path is cleared for more policy easing and rate cuts in the region.
Well, it's interesting you ended on that. I mean, we've got this week coming up the RBI in India and the BSP in the Philippines in terms of central bank decisions. Do you think we'll get signs of that dovishness coming through already, or do we expect things to be unchanged for the time being?
No, we do think both central banks are likely to be dovish. We are expecting a 25 basis point rate cut for both, which is in line with consensus. But I think the tariff announcement is new news for both the central banks, and the downside risks on account of that will essentially need to be incorporated this time around. So for India specifically, outside of the 25 basis point cut, the focus is going to be on the stance. It has been neutral. Our view is the RBI is going to retain it at neutral, but incorporating the higher tariffs, we think the growth projections are likely to get downgraded from current projections of 6.7 to 6.5, while retaining the inflation forecast at 4.2%. What's new at this MPC is a new deputy governor, Dr. Poonam Gupta, has been appointed. So her views and stance is something markets will be looking at. I would say there's a lot of discussion around whether the RBI can go even more aggressive and cut by 50 basis point or change its stance to accommodative from neutral. That's not our base case. Similarly, for the BSP, the 25 basis point cut will come after the surprise pause we had in February. Inflation's actually panned out extremely favorably, with the March CPI, in fact, below the BSP's target range. So we do think the statement is also going to be dovish.
Great. So there's quite a lot going on. There's obviously a few other data points this week. What are you looking at other than the central banks, Sonal?
Yeah, there are two other things we're watching. One is Singapore's Q1 GDP advance estimate, where we think there's going to be a sharper deceleration in growth. So from 5% in Q4 to 4.2%. This is on a year-over-year basis. So on a quarter-on-quarter seasonally adjusted basis, we think there's going to be a sequential decline, mainly because of a fairly sharp fall we've seen in the industrial output growth. This, in turn, we think, along with the new tariff announcements, will lead the MTI to lower its 2025 GDP growth forecast range by 0.5 percentage points. And this also, in our view, sets the stage for the MAS to ease this month, where we are expecting a 1% slope reduction to zero. The other focus will be the CPI prints we are getting in Indonesia and Taiwan. Both are expected to rise on the headline basis. But this actually increase comes after some temporary factors that held inflation down. So the Lunar New Year effect in Taiwan and the electricity rate discounts in Indonesia. So it's more of a normalization towards the underlying trend, and inflation's not really a concern.
Great, thanks, Donna. I would say from the FX perspective, obviously we're kind of pretty aligned with that view in terms of thinking the Sing dollar can underperform with that potential slope reduction. So definitely something to watch in Singapore there. Thanks again for your time, and we'll speak to you soon.
Thanks, Tom.
We're going to finish off down under this week. We've got Andrew Ticehurst here. Andrew, thanks for joining. Next week, we've got the RBNZ meeting. It's the only G10 central bank next week. What are we expecting from the RBNZ?
Yeah, Dominic, thanks. Good to be with you. Look, we're pretty confident we'll get another 25 basis point rate cut from the RBNZ that will take their policy rate from 375 down to 350. As we look at them, we're really guided by big picture sort of first principles here. Fiscal policy's tight, the economy's been in recession, and there's a lot of spare capacity in the economy. We think in that environment, the most appropriate thing for the central bank to do is to get monetary policy back towards neutral pretty much as quickly as possible. When you throw in downside global risks, that only adds to the case. So yeah, 25 basis points from the RBNZ next week, and probably a follow-up 25 basis points in May as well.
Great. Thanks very much, Andrew. Have a good week ahead.
Easy. Thank you.
That's it for this week. We hope you feel fully liberated. Thank you for joining us on the Weekhead podcast. As always, expertly edited and produced by John Dalton. If you did enjoy listening to the show or want to hear more from us, please like and subscribe to Nomura's podcasts on Apple, Spotify, SoundCloud, or wherever it is you get your fill of podcasts. We'd also love for you to share the pod with any friends or colleagues who you think would enjoy the show. Please also feel free to leave a review, good or bad, as we'd love to know what parts of the pod you like and where we can do better. For more, log in to nomuraconnects.com to keep up to date and to keep on listening. Thanks again, and good luck for the week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision, and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice, nor is legal, regulatory, accounting, or tax advice, and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.